So let's talk about the Nigerian stock market, which went up 50% last year, and that's leading the global space in the year 2020. But much less was reported of the fact that nearly ₹500 billion in commercial papers were raised by local companies on the country's exchanges. And these positive developments were recorded despite the global COVID-19 pandemic and the fall in crude oil prices, as well as the general economic downturn. Now the new year 2021 is taking off, again on a strong note at the corporate debt market right now. Johnson Chukwu, the CEO at Cowry Asset and a licensed trader, joins me now to review some of this. Good evening, sir. Thanks for coming through on the program.
Good evening, Bosin. Once again, thank you for having me.
Thank you. Let's go through some news. It looks like quite a whole lot of fast and furious news happening around your market streets. Even though the National Commodities Exchange is based in Abuja, I'm sure you're very well aware of the story, of the history of this particular exchange. Now, the Central Bank, the Ministry of Finance, says they want to take it off the ground. Resurrection is the word.
Yes, Bosin, like you rightly said, it's been in the works for more than 25 years. And it's absolutely necessary if we have to deliver agricultural sector. The reasons why the Central Bank, Nigerian Security and Exchange Commission, the Ministry of Finance have been pushing are now willing to ensure that we actually create an commodity exchange that's operational is because you really can't have a fully developed agricultural sector if you don't have a commodity exchange. Remember, part of the reasons why agricultural activities is not profitable because you have a lot of wastages. But the commodity exchange will, one, ensure that you have standardization. Two, that the losses you find at the farms will be reduced because some of those commodities will be sold or some of those farm products will be sold in advance on the exchange. And without that exchange, and you have in other countries, you can have a well-structured primary market for the production of some of these commodities.
But again, that's one good news. But again, another news today is the repayment of the $500 million Eurobond by the Debt Management Office. Very surprising. Some folks thought Nigeria would default, but this is Nigeria scaling the wall, as it were. How positive is this news for the market?
Well, anybody who was expecting Nigeria to default wasn't looking at the facts of the matter. Nigeria's reserve is about $35 billion. Nigeria's earnings are strong enough to meet all its current foreign currency obligations. So I wasn't expecting Nigeria to default for any reason whatsoever. But the key thing that would have happened in the economy with this $500 million payment is that for local investors, remember the Eurobond is held by both foreign and local investors. For the local investor component of the holders, you're going to see improved liquidity in the FX market because those funds will be looking for alternative investment outlets, which are barely available today. Returns have actually collapsed even in the Eurobond space. So you're going to see a lot more dollar liquidity pursuing few dollar assets. And that will also further depress interest rates in the dollar market. Again, like I also said, with improved that dollar liquidity, because you're going to see a shift in dollar holding from federal government reserve to individual balances, and those balances will be available in the market. So I think we're going to see a lot of improvement in dollar liquidity in the economy in the next few months. On the reserve, of course, we are going to see a depletion in the reserve because part of those holdings were held by foreign portfolio investors who will want those funds transferred back to their local economies. So apart from that, but the portion held by Nigerians will lead to an improvement in dollar liquidity within the Nigerian economy.
Thank you so much speaking to us on that. But while we stick with the debt market, let's come back home and talk about nearly 500 billion naira, which was raised as commercial papers on the Nigerian market between January and September last year. And this was during the year of the pandemic. How does this happen? What does that really show about the Nigeria's debt market, whether for public companies or private companies?
You know, the Nigerian money market went into overdrive last year. Simple reason is that we saw a collapse in interest rates. I mean, through CBN actions, we saw short-term money market rate drop to below 1%. And that incentivized corporate institutions with strong balance sheet to go to the market and disintermediate, because companies raising CP or commercial paper is actually what we call disintermediation, because they're borrowing directly from the surplus units instead of going through the intermediary, which is the banks. So because of low interest rate environment, investors or surplus units or those who are depositors were looking for alternative investment outlets, and the commercial papers became handy. So because they could get returns higher than what they were getting from their banks. So they were ready to place their monies directly with the corporate organization that have strong balance sheet than to place those funds with the banks who would have lent it to those corporate organizations. And that's what triggered the activity to soar in the commercial paper space. As long as you have low interest rate environment, at a time when investors have surplus units, look at the major fund managers, such as the PFA, the pension fund administrators. They were looking for outlets to invest their money. And the commercial papers were the most high-yielding, short-term money market instruments. Again, you also recognize that investors were also wanted to stay in the short end of the market, because with low interest rate environment, they wouldn't want to play long. Going long will mean that should interest rates recover, you may suffer losses. And that's why the short end market was the most viable market in last year.
Okay, so we're now getting into the new year, and it looks like this debt market is good. We got put a bit of these bonds and CPs out on. I think we can just put that on the screen. When we look at the total portfolio last year, 478.4, but look at this year already. Look at the screen; it's filled up between public companies such as Flour Mills and Total, which is an oil retailer, and Flour Mills. But you have other companies such as Mixer Real Estate, which is a private company, Garden City is a private bond offer, and even Emzo Pharmaceuticals and Valency Agro. What's the push?
Yeah, boss, let me put a context to it. You know, in economics, at periods of low interest rate environment situation, borrowers will want to play long, go to the market and raise long-term instruments. The appropriate thing is to get into the market, lock in on long-term instruments at the time when interest rates are low, and particularly if those instruments are fixed yield instruments. So you don't have to reprice your cost of funds as interest rates move up. So the appropriate thing, which is why you are seeing a lot of activities at the primary end of the market, where issuers or corporate organizations are coming to the market to raise long-term instruments. At the same time, the most appropriate thing for lenders is to play short, because you don't want to lock in on long-term instruments at a time when rates are so low and you expect rates to go up. But interestingly for the Nigerian environment, because they are not alternative investment outlets, investors are going to take up these instruments because particularly for those fund managers who are getting their liquidity on a monthly basis, they can't afford to continue to keep all their monies in very short-dated instruments. And that's why you will see market for this. But I do not think the market will be as deep as the number of instruments coming to the market, because I know some of the offers that happened early this year, they were not fully subscribed, because investors are also cautious of the fact that interest rates are gradually beginning to itch up, and they would rather stay in the short end of the market. So I expect you're going to see a lot more activity in the commercial paper space than in the bond space for investors. But for the issuers, their preference will be to play long, lock in the long-term funds at these low rates, and then enjoy it over a long period of time.
Johnson Chukwu, we thank you for your time tonight. Johnson, thank you so much. This is Johnson Chukwu, CEO at Cowry Asset Management.